Good morning, you've tuned into ET Now. This is Buy Now, Sell Now with me, Karunya Rao and Varun Hiramat. Let's kick off the show by taking a look at the top headlines and the newsmakers of this hour. First up, new day, new high for the benchmark indices. Nifty has topped 13,400 right now, just testing those levels as we speak. SENSEX has also surged nearly 200 points. PSB indices lead the rally. Metals and pharma stocks, however, continue to sulk a tad bit. You have some brokerage share coming in. CLSA has maintained a buy on ACC with a target of 19-20 rupees a piece. CLSA has also maintained a buy on Ambuja cement with a target of 285 rupees a share. Ambuja and ACC rolled over TKHPs in 2018 is something to watch out for. The lack of technology fee clarity could be an overhang on the stocks, however, but yes, they do continue to trade at attractive discounts according to the global brokerage. You also have some home materials and home building stocks surging in trades. Asian Paints says home improvement demand to remain upbeat. They see new demand coming up, resurgence especially in Tier 1 and Tier 2 cities. Century Ply also spoke to us earlier in the day. They expect double-digit growth going forward. They've rolled out new technologies that have become industry standards, and going forward there could be substantial reduction in organized sector. And finally, you have FM Nirmala Sitharaman giving some commentary as well. Sustained recovery seen from Q1 of FY22 onwards. Some encouraging and forward-looking comments made there. India Tier 2 and Tier 3 cities will lead the demand according to the Finance Minister. She also adds that rural economy will see a sharp recovery in demand, a sustained demand outcome of India's stimulus efforts, and admits that fiscal measures would always fall short. Stimulus of 10% of GDP aimed at specific stakeholders, India and RBI have done very clear balancing, says Nirmala Sitharaman. Meanwhile, it's D-Day for Tata versus Mistry. SP Group seeks pro-rata split of assets as well as liabilities. The hearing is happening at the Supreme Court today, and the SP Group, which is the Shapurji Palonji Group, estimates their stake to be worth 1.75 lakh crore. Tata Group estimates are much lower value to the shares. And finally, you have Yes Bank flying in trade. Global PE's eye stake in Yes Bank ARC. The stock is up more than 7% as we speak. So these are the top news makers in trade. Varun, why don't you update us on how the markets are faring?
Yeah, sure, Karanya. Let's take a look at the markets. You know, when you woke up this morning and you took a look at the global cues, they said, okay, fine, finally our market's going to come to a halt today. There's no way we can keep going upward, right? Because the Dow yesterday slid 150 points. S&P also slid. Only the Nasdaq did well. And then even the futures this morning were 70, 80 points down further for the Dow. So we were all expecting a muted day in trade, and then we opened obviously and went to 13,400, 13,435. That was the high point of the day. So we've cooled off a little bit. We're at 13,390, but still a good 0.3% higher. Breadth is pretty much split 50-50. You have 25 advancing, 25 declining. In terms of what's doing well, we have Ultratech Cement. That's just been flying since that CapEx announcement. We have Reliance making a strong comeback today. It's also cooled off. It was up 3%. It's now up only 2%. Then HCL Tech also making a comeback today, and Infosys. So two IT heavyweights, both in the top gainers on the Nifty. Then Maruti is also doing well today. On the losing side, you have Sun Pharma taking a bit of a breather. That chart's just been on a one-way move since March. Coal India 2% down. IndusInd Bank cooling off, but at 920 bucks. What a comeback that one's also made. Hindalco 250 down 1.5%, and then Adani Ports cooling off post that Goldman upgrade yesterday at around 465. So in terms of the benchmarks, the bank index is a bit of a sore loser today, 0.3% down. The auto index is holding its ground. We're up almost 0.2%. The mid-cap index, broader market today, sluggish a little bit, 0.2% down. And then the next 50 is also down around 0.2%. So that's how the markets are faring. But turning to an all-important personality for the Indian economy and markets, speaking at the India Mobile Congress today, Mukesh Ambani sounded extremely confident of the progress in India's tech hardware capabilities and a digital ecosystem. Here's an excerpt of his comments.
The outbreak of COVID-19 posed life-threatening challenges, but our high-speed 4G connectivity infrastructure has proved to be India's digital lifeline. Throughout 2020, India worked online, studied online, shopped online, received healthcare online, socialized online, played online. Simply put, India thrived online. This underscores the phenomenal evolution of digital technology in India. From being a means of limited engagement and entertainment, it has evolved into a platform of unlimited enablement and empowerment. Despite the lockdown, the entire industry, consisting of thousands of engineers and employees, worked round the clock to provide critical support 24/7 to all sections of the society and business. The government supported the industry to go the extra mile in keeping these critical services going during this period. They deserve our appreciation and gratitude. Honorable Prime Minister, with great admiration and enthusiasm, the nation has welcomed your announcement about the early availability of an affordable COVID vaccine. The pandemic will surely be behind us soon in 2021. Under your leadership, India will welcome the new decade with supreme confidence. The Indian economy will not only bounce back, but will also grow with unprecedented acceleration. India can and India will prove cynics wrong by becoming a $5 trillion economy.
All right, some important comments coming in there from the top boss of Reliance Industries, Mukesh Ambani. Let's pull up quickly the BNSN quiz of the day as well, just to remind all of our viewers who've tuned in just now that they can still participate by sending us their answers. The question we asked you today is, which IT heavyweight reported the highest ROE in the last fiscal, that's FY20? The options being TCS, Wipro, Tech Mahindra and Infosys. So if you still want to participate, you can do so by logging on to our Twitter handle, ET Now Live, and posting your answers in the comment section. Okay, back to buy now, sell now, and to the markets. How has the recent run-up in the market been different from the recent polarization phase? Jayesh is here to tell us more about the same.
What has really stood out in the recent run-up in the market since 30th of October has been the fact that we have seen increased participation not only from the broader market universe but individual stocks also contributing positively towards the Nifty's gain. One of the ways to look at it is the fact that all of the Nifty stocks are currently above their 200-day moving average. And it is for the first time since 2009 that we have seen such kind of participation from the individual stocks as well. And the first chart will really show you that picture that since 2009 this is the first instance that all 100% Nifty stocks are currently above their 200-day moving average. What is also really standing out is the fact of increased market participation. Now there are two time frames that I have looked at. One is since the 23rd of March 2020, where you had the top 5 stocks contributing nearly 50% of the Nifty gains of more than 4,500 points, and you had the usual suspects of Reliance, Infosys, HDFC Twins along with ICICI Bank that made it to the top 5 list. What is standing out in the recent leg of the market since 30th of October is a sense of increased participation, because the top 5 stocks, not only have the stocks changed, but the participation has also reduced, which is nearly 40% has been contributed by the top 5 stocks. What really stands out is the fact that 49 stocks on the Nifty since 30th of October have contributed positively except for one, and that one being Reliance Industries, the heaviest weight on the index itself. So you have HDFC Twins that are contributing positively since 30th of October, along with new entrants like Bajaj Finance and Kotak Bank, which have also contributed about 100 points each to the Nifty's gain since 30th of October.
All right, that was some very interesting analysis by my colleague Jayesh. But let's bring on our experts this morning. Kunal Bothra and Rajesh Agarwal are both with us. Good morning, gentlemen, and thanks for taking out the time as always. Kunal, coming to you first. As Jayesh was pointing out, we've never seen market breadth which is this positive. Today, the Indian market has a mind of its own. It's not following the global cues. We've made up our mind that we want to scale toward the lifetime high. So, I mean, where are you? Should we be cautious now, or is this just the beginning of a new bull run in your view? And then obviously, where's your high risk and then a low risk idea for our viewers?
The markets are into a scenario where a lot of the I would say different things are happening this time around. Something which has not been seen in the last 4 years, 5 years, or in the last decade as well. It doesn't come as a surprise that the market breadth has opened up so well, and you've seen the entire Nifty 50 stocks above their 200 moving averages. But whether this is just the top of a bull market or whether this is the start of a bull market, that I think only time will tell. But you have to look at in terms of trading opportunities, where is the market heading towards in terms of short-term trades, whether there is some sort of a trend which is emerging into some sort of a stocks or sectors, or whether this is just a normal consolidation which goes on, and you might see a routine kind of a correction happening to the indices. So I think in this regards, there have been a lot of positive sectors and positive signs which you've seen for the markets in the last couple of days. And I think one has to try and take all of these aspects one by one, and then try and assess the market conditions. So on short-term charts, for example, many of the stocks have got back into extremely overbought kind of territories. But when you have such kind of a liquidity flow and liquidity gush, it becomes very difficult to try and assess where the actual top or when the markets would start to correct. So rather than anticipating the top, I think one has to try and trail their stop losses higher. So I think that's the better strategy in terms of trade. So earlier, start of December, the trailing stop loss was 12,800. That now should get shifted to almost 13,200 on the Nifty. So I think till the time the index is trading about 13,200, traders should maintain long bias. Coming back to the stock ideas, to buy calls, I would recommend first is a buy on Wipro. We'll term this as a moderate risk idea, given the fact that many of these IT stocks could move up higher from current levels. Targets of 380 approximately. Stop loss could be kept at 355. And the second would be a buy on Container Corporation. I'll term this as a more of a low risk trade because of the relatively low beta nature of the stock price. The stock is trading above the 200 moving averages. The golden crossover is also very, very close by for the stock price, where the 50 DMA can cross over above the 200 moving average as well. So Container Corporation is the buy. Targets of 440, stop loss 395.
Okay, Rajesh, hi, good morning. What are your fundamental bets that you'd like to flag off to our viewers?
See, there in the mid-cap space, Karuna, there are a lot of stocks which can be bet even after this kind of rally which we have witnessed in the last 5-6 odd months. But still, two stocks which stand out are Graphite India. We have seen quite a lot of interest, but of that Graphite India or the likes of these companies would move on because they make graphite electrodes which are used in steel industry as such. And it's a product which is used in EAF route, that electric arc furnace route, and it's one of the largest player by capacity in India, with 3 plants in India and 1 in Germany. With the kind of capacity utilization going up, the demand going up, they have good set of clients like SR Steel, Tesco, etc. I think this stock can give very good returns. In the medium term, we believe that 20% upside from the current market price is quite possible. The only concern being exports to Iran, which are facing difficulties, and the slowdown in China. But I think these things are temporary and will be taken back. The second one I would bet on is Varun Beverages. It is one of the largest players in beverages industry, I would say, and the biggest franchisee of Pepsi outside US, and it has operations not only in India but also outside like Nepal, Sri Lanka, Mozambique, Morocco, etc. They have recently started operation in South End, where the rural demand is going up. Even the non-carbonated drinks market is going up like anything, and I think this can be a very good play in a soft drink industry, the demand for which is going up in India. So Varun Beverage would be one of the second best, second pick from my side, with again 20% upside from the current market price.
Okay, thanks for that, Rajesh. Let's now get on board with our queries. And we have Tushar, who's written to us again. He's quite a daily feature almost on Buy Now, Sell Now. Please suggest some mid-cap stocks to enter. So that kind of follows on from what Rajesh was just talking about. But he's looking at things on both a short and long-term view. So, Kunal, any mid-caps on your radar that are looking poised for a decent up move?
Yeah, I think there are quite a few mid-cap names, which look, quite interesting, Varun. And I think it depends on the risk appetite and the time frame for the investor. So, few of the names which, I've been liking. Rain Industries is one stock which looks extremely attractive. It's a bit, high beta in terms of, the nature of the stock price. But if you're ready for, some sort of, high risk trades, then I think Rain Industries could be one stock which you could look at. It's completed a lot of chart patterns on the longer term kind of a time frame, and that could result into the stock going into a multi-month upside. You could look at something like a Tata Power as well. So I think the stock at 70 odd rupees also has confirmed breakout on multi-time scale analysis. So both on the weekly as well as on the monthly charts, there have been some big breakouts for Tata Power as well. That could be the other stock. You might look at KEC Industries or KEI International. Both of these stocks are also looking quite well. So the markets are looking quite strong. There have been a lot of mid cap names which are doing pretty well. So I think the list can keep on continuing. But these are the few names which you can look at, especially if you are looking at it from both a trading as well as from a positional point of view.
Okay, what about you, Rajesh? Other than what you've already highlighted to us as part of your ideas for the day, any other names from the broader market that you'd like to recommend to Tushar?
Yeah, as Kunal just said, the list can be very long, it can go on, but 2-3 names I would like to suggest apart from those two. One would be Dalmia Bharat. It's one of the mid-cap cement play. The numbers have been pretty good. The highest EBITDA by EV level reported by any company in mid-cap space. The capacity expansion is going up. Would again reflect in number. The second one would be Jindal Steel and Power, where we have seen production and sales going up month on month, and gold capacity has been ramped up. And this is again going to add to the number. The power capacity is also doing very well in that company. And the best part is the management is keen on reducing the debt. That again would increase the margin. The third one, of course, would be CESC. That's one of the basic electricity companies. The numbers have been pretty good. All the plants are doing well. We believe that FY22 EPS would be 95 odd rupees. And considering that the is quite cheap when you compare to other peer group companies. So hence we can start.
Okay, well, I hope Tushar is taking note of all the short and long-term ideas that Kunal and Rajesh just flagged off. Moving on to query number 2, Kavin Maheshwari writes to us from Jaipur. He's bought 500 shares of UPL at the price of 590 rupees per share. He wants to understand whether he should cut his losses and exit, or should he stay invested. Kunal, how are you reading into the chart of UPL, and do you think it's likely to recover more and perhaps breach the buying price of our viewer on the upside?
I think 590 is a bit of a higher price for UPL, because I think the stock in the near-term trend has damaged quite significantly. I think from that September high of 530, 535 for UPL, it's seen a very, very sharp kind of a correction. Now you're in the process of seeing a bounce for UPL, but the concern when I look at the charts for UPL is the declining or the decline in the slope for the 50 moving average and the 200 moving average. This generally is not a good sign. This generally happens when you see the stock going into a downward drift. So, I would suggest that, if you're in for a longer term view, then it's a different ball game altogether. But if it's purely from a short term view, then I believe that you should probably have a stop loss mechanism over here. A 200 moving average stop loss could be an ideal stop loss for you. I think that level is approximately at 440 or 435 on the spot level. So keep that as a stop loss and hold on to UPL. But I think below that level, I believe that there could be a chance that the chart patterns may get a bit dented.
Okay, thanks for that, guys. Let's get on to query 2. 500 shares of UPL at 590 rupees per share. Rajesh, what's your view here? Just an interesting fact, UPL used to be India's largest ag-chem company and 5th largest in the world, but the market cap of PI is now a good couple $100 million above that of a UPL at the peak last week. So what are your views over here?
You said it right. PI Industries has been growing on market cap basis by leaps and bounds, but we should not forget that UPL is a global player in agricultural solutions. The Q2 numbers have been pretty good. We have seen both the top line and bottom line going up. Even the margins have expanded. Merger with Aristia, acquisition of Aristia would be a great thing for this company going forward. The only problem in the recent past was the resignation of some auditors in the subsidiaries, and that caused a toll on the share price. But I think going forward with the kind of earnings, with the kind of global presence this company has, one should definitely hold on to the stock with a price target of maybe 540 odd rupees in the next 1 year or so. So I would suggest if you have a long-term horizon, if you don't have any hurry for encashing as of now, one should definitely hold on to the stock.
So clear-cut advice from Rajesh regarding UPL. On that note, thank you to you both for joining us this morning. It was great for you to help out our viewers. But let's now switch gears. We have an exclusive ET Now story from my colleague Ajay. One of the underperformers of the pharma sector on the back of debt issues has been Glenmark Pharma. But things could change drastically very soon for the better. Ajay, what are you picking up from your sources?
Well, we are gathering from our sources that Glenmark is in active discussions with multiple parties for a transaction to monetize their R&D arm, which is Equinox. We understand that two simultaneous talks are happening in pretty advanced stages. One set of talks is happening with the global private equity companies. Clutch of private equity companies have shown interest to pick up minority stake in Equinox, which is their R&D arm. And these are US-based private equity companies which already have a very big, wide global healthcare portfolio. So they understand this space well and is very interested in scaling up their R&D investments, and then hence they are looking at Glenmark R&D arm for that. Another set of simultaneous talks actually happening with the multinational pharma companies to monetize or out-license some of the pipeline of the molecules from this R&D arm. We understand that the discussions are fairly advanced stages. The rough valuation talk which is happening between the parties around $800 million to $1 billion as far as their the R&D arm valuation is concerned. So depends on the kind of minority stake sale would happen. Is something the kind of proceeds will come into the company around 24%, or we are still unclear about that. And we understand that the management is very focused on reducing their debt levels. The gross debt as of September ending was a shade lower than 5,000 crore, 4,700 crore thereabout. So they are keen in reducing that very sharply. In fact, they have guided for this direction of path in order to reduce their debt as well in the second quarter call. But we understand that these talks have actually reached a pretty advanced stages. Specific offers have started coming on the table, and it should happen very shortly, perhaps by mid-January is what we understand. We spoke to the management regarding this, and they refused to give any specific answer, any specific queries regarding this story. But this is a big monetization plan which is underway at Glenmark.
Right, Ajay, thanks much for that exclusive update on Glenmark. Amphi data has started to trickle in. The November data net inflows stand at 27,194 crores versus an inflow of 98,576 crores on a month-on-month basis. And equity outflow stands at 12,917 crores versus an outflow of 2,725 crores. Jayesh is standing by to fill us in more about all the fine print of the data that's coming out and what are the key trends to watch out for. Jayesh.
Karunya, it's a disappointment on all fronts that we track the data, because if you have a look at the net flow, despite the fact that there is an inflow of 27,000 odd crores, but the key categories, most of them have seen an outflow. Starting off with the debt category, you have the overnight fund and the liquid fund. Both of them on a combined basis have witnessed a 25,000 crore outflow this time around. What is even more disappointing and concerning is the fact that the equity outflow that has come in at nearly 13,000 crores for this month. And this is the fifth straight month that we are seeing equity outflow. And the last time I don't remember seeing a number in excess of 10,000 crores. So extremely alarming and concerning, I would say, what Amphi has reported. Quick deep dive into, the individual categories. The multi-cap category has been witnessing outflows, and this time the acceleration is extremely large. Nearly 3,000 crores goes out from that kitty. The large cap funds, this has come in as a surprise because 3,289 crores is the outflow number that we have seen this time around. So, on a combined basis, this is almost 6,500 crores that has gone out from the two categories itself. You have the small and the mid-cap category, which have also seen an outflow of more than 1,000 crores each. And if I combine the equity outflow number along with the balanced fund outflow, then that outflow even becomes larger and balloons to nearly 17,000 crores in terms of the total equity outflow. So I'm trying to find out, if there is a positive number, but unfortunately I cannot look at any of them except for the fact that, the AUM picture has been extremely stable, because that is also a function of the market as well. So you have the total AUM that has surged by 5%, and the equity AUM on a month-on-month basis has surged about 6%. But this again is lesser than what the indices, the benchmark indices did in the month of November. So all in all, extremely disappointing, alarming and concerning is what Amphi has reported this time around.
All right, thanks for that, Jayesh. Let's now also go across to Saurabh Mohanty, who's with us. Hi, Saurabh. Good morning. What's your read on the Amphi data? Given that we knew DIIs are constantly selling over the last couple of weeks, it's been reported every evening. Did you expect there to be such a large outflow, or is it also, in your view, slightly alarming?
Actually, the final numbers are lesser than what I had expected, quite honestly. Because if you see, I think Jayesh put it in the right perspective, and you see the increase in redemptions month on month. If you see the last month, broadly the redemptions in equity in the industry was around 20,000 crores. This month it shot up to 27,000 crores. And bulk of the redemptions have been seen in the multi-cap and large cap primarily. But you're seeing an heightened redemptions in the mid and small too. That is probably due to the market run-up or the abnormal returns which the small caps gave. So I think some amount of profit booking has happened on that, which has skewed the numbers a little higher than the last number. But I've not seen a proper, redemption across categories after a long time. So yes, the data is very different from the earlier months. And the hybrid, of course, also has seen a higher amount of redemption. So combined, it's probably the worst month in the last 5-6 years. Yes, and it could be a market factor of the markets being high. But I do believe that, with this kind of data, we know how to think differently. These are large numbers. I agree, these are large numbers.
Is joining in the conversation as well. Swaroop, I want to, highlight the fact that in our previous conversation, you had mentioned that it's a good thing that the domestic institutions are on a selling spree, because you were net buyers in the month of March, and this is essentially a function of profit booking. I remember the line that you had made that, this is money going out which has been made on the back of money. So, this 13,000 crores is still a fairly large number. Do you still think that this is a sense of profit booking, or this is accelerated selling now that we are seeing in the market?
Yeah, Jayesh, I mean, the point that I had made in our previous discussion is that if you look at the March and April data, we were net buyers. So I am very happy that, when you look at the maturity of investors, they had preferred to buy at that point of time. And I have no qualms in them selling off at these levels. Whether the market is high or the valuations are high, I am nobody to comment on that. Time will only tell. But if people have bought at those levels and are selling at these levels, I think it's a far more logical way of behaving than the other way around, was the point I was making. But yes, I do agree with you that, when you look at data which is like this and which is now sustained over the last 4 or 5 months, I mean, the outflows from the industry. Please, again, if you remember that conversation, I had said that, people had bought equity for 5-6 years continuously also. So at least, and the people I was talking about having made money was purely on the money which has gone out from Mira Asset funds. I mean, I'm very happy to report that people who have left Mira Asset or have redeemed in the last 2-3 months are people who have made good money. So good money is not the right way, but have made money. I'm nobody to decide whether it's good or not. But so that's a very comforting thing, as long as people make money and go out and they have invested to make money. Nothing wrong with that. But at the same time, Jayesh, you cannot ignore the inflow on the debt side. Look at what's happening on the debt side and what has happened for equity for the last 4 or 5 years. I hope and pray that the same kind of inflows happen on the debt side for the next 2-3 years, because the inflow that is happening across the debt categories, and especially in the longer debt categories, which is the corporate bond fund or the bank and PSU fund, which are core funds, is also a very refreshing thing to see.
Sarup, wanted to also get your view on, if you look into the individual categories. So the multi-cap fund has seen an outflow of about 2,900 crores. Of course, now we know that the flexi-cap scheme has been introduced, so it will be a natural progression for all fund houses to shift their multi-cap fund to flexi-cap. So this is a natural progression that we are seeing, that eventually this multi-cap money will come into the flexi-cap. And the other one is that, we are seeing 3,300 crores go out from the large cap category. Now, this is very concerning, because this was one end of the market which was actually holding up the entire market in terms of the polarization that we had. So I wanted to get your views on this.
Yeah, I think what you say on the multi-cap side could be a reason for, that confusion on the multi-cap side could be a reason for this outflow. But typically large cap and multi-cap redemptions go hand in hand, and I think the next 2-3 months will decide whether it's just been a one-off sort of redemption or people are getting out of these two categories. This is the first month we've seen such large redemption put together. I think around for one is 5,300, one is 5,900, and that these are not small numbers from a gross redemption perspective. Net is 2,800 and 1,200, whatever you put. But if this is sustained over the next 3-4 months, then we could probably talk about a trend. But this is the first month of such a large number. And then since it's come off a backdrop of a confusion over the multi-cap category, and now that it seems to have been sorted with the flexi-cap category, I will reserve my comments on the first month.
Sarup, for hand.
All right, thanks both of you for joining in and helping us break down the AMFI data for the month gone by. It's slipping into a break here. More updates on the other side. Keep it with Buy Now, Sell Now. Welcome back. You're still watching Buy Now, Sell Now right here on ET Now. Let's talk about some stocks making the news. Then you have ACC and Ambuja on the radar. CLSA has come out with a bullish note on the cement space, specifically talking about these two companies. Vivek is standing by with all the highlights. Vivek.
Well, the two companies that would be in focus are the two Lafarge Holcim cement companies in India, that is both ACC as well as Ambuja. Now, what we have to keep in mind is that ACC as well as Ambuja actually pay a certain amount of fees known as the technology and know-how agreement fees. Now, what is actually happening is that on December 31st, 2020, the agreement that both ACC as well as Ambuja have with the parent company comes up for renewal. Now, there is a certain amount of overhang that develops on the back of this particular development, on the back of the fact that, remember, the TKH fee or the technology know-how fees are currently at 1% of the revenue. Now, what analysts are penciling in is that the market at this point of time is most likely factoring in that this particular fees or this particular royalty payment that the company does to its parent company would continue at the current rate. But the overhang starts developing once analysts start penciling in a slightly higher technology know-how fees. Now, why is this particular analysis or why is this particular fee so important? Given on sensitivity analysis, CLSA says that a 1% higher TKH fees could actually lead to 4 to 6% lower EBITDA for Ambuja and a 6% lower EBITDA for ACC, and therefore implying a significantly lower value. So what they are saying is that the 1% higher TKH fees could potentially neutralize the MSA benefits that both ACC and Ambuja have now started enjoying with each other.
Okay, CLSA looking quite positive on cement. But coming to a sector that's also quite linked to the raw material, as construction activities will swing up their pace, market veteran Nilesh Shah remains confident of building materials as a space and says it will remain attractive in the long haul. Let's listen in.
Coming back home, clearly believes that home construction and construction activity in general is going to be on an upswing. And so clearly believe, and that's purely because, again, stemming from, a lot of the fiscal SOPs which the government has been giving out for buying fresh homes. Basically, again, the kind of SOPs which government is having to promote investment activity by lowering tax rates. And of course, the whole Atmanirbhar program of the government. And I think because of this, you're going to see a lot of backlog of inventory getting cleared out. You're going to see new homes getting constructed. You're also going to start to see new factories getting constructed, new factories, new godowns, new fulfillment centers, and a lot of the other general construction activity. So my sense is, and our view is, that building materials as a space continues to look very attractive. Of course, the conventional paint companies and all of that will do well. But one space which is looking extremely attractive is essentially the wires and cable space. And I think clearly out there, the demand, I think, continues to be very, very strong. Valuations are very, very attractive. These are capital efficient companies, debt-free companies. So to that extent, my sense is that this is now turning out to be a very, very interesting pocket to own and ride for the next few years.
Okay, time for a quick break here on Buy Now, Sell Now. Stay tuned. We'll be back in just a minute. ET now, and this is Buy Now, Sell Now. It's the Bharat Bandh today. We all know that. Farmers have called a bandh to stage a protest against the recent agri reforms that the government has rolled out. The stir is expected to continue till 3 p.m. at least, with transportation services, offices and shops kept shut in a few cities. Our network correspondent Disha Shah is at the Mumbai APMC and Shrija is at Bengaluru to get us a ground report. Let's go across to them.
Well, if you talk about APMC market here in Vashi, where I am, it's completely shut because of the farmers' protest and the Bharat Bandh. The traders here decided to keep closed for one day all the APMC markets here in the state of Maharashtra. This is Vashi's APMC market. It's anywhere near 11:30 a.m. At this given point in time, the market is always buzzing with people, with traders, with wholesalers, retailers, even trucks. There are about, at any given point in time, more than 100 trucks here, parked here with essential commodities. But here you can look at that because the market is shut for the day, the place looks pretty much deserted. The mandi here looks pretty much deserted, and this is going to have an impact on the essential commodities like fruits and vegetables, grains for that matter, and that impact is likely to be seen tomorrow because the market is shut today. So tomorrow that impact could be seen on the ground level, and traders, of course, of the APMC here, they believe that the reason they are supporting the farmers is because the farm laws, it did not really go out well with them as well. They feel that this will weaken the APMC system here, and it will also impact the livelihood of the traders. So all the APMC, be it here in Navi Mumbai, if you talk about Pune APMC, Nashik APMC, Kalyan APMC, all of these APMC markets have remained closed for today to protest and to support the Bharat Bandh here in concern. Well, on one part of the city, we are witnessing a protest taken out by farmers and various other trade unions. But I'm here at APMC market in Yashwantpur. This is one section of the APMC market. This is the Onion and Potato Traders Association. We are looking at where the business is in full swing. You can also see there is so much activity that's happening. And there is also auctioning that you can see at this point in time, even though we are calling it as Bharat Bandh. But of course, the trade unions at this point in time, they have already lent their support, but what they tell us is that they have received the supplies from various states, including Maharashtra, just early this morning. But as far as any other day, when you're really comparing it, today the bags that they have received is much lesser. Let me go across to Mr. Lokesh, who's the president of Onion and Potato Association. Sir, can you tell us that if you are lending support to the Bandh and how you are protesting?
देखिए, हमें ये भारत बंद के लिए हम लोग ने हमारा एसोसिएशन के पूरा मीटिंग करके ये साधक बाधक दोनों योजना सोच के बाद में हम लोग एक डिसीजन लिया है. अभी सपोर्ट करना बोले तो किसान लोगों को सपोर्ट हमारा 100% है, लेकिन भारत बंद के लिए हमें सपोर्ट करने का होता नहीं है. इधर किसान लोगों को मार्केट को किसान लोगों को प्याज लेके आता है, पेरिशेबल आइटम हमारे का आता है. जो कुछ आया वही दिन हमें क्लियर करने का. अगर नहीं क्लियर करे तो आज का स्टॉक या कल का स्टॉक दोनों मिलके रेट में बहुत फ़र्क होता है. एक एक पीसी को 200-300 रुपए का फ़र्क होता है आवक ज़्यादा आने की वजह से. इसलिए हम लोग ये डिसीजन लेके हमारा कल डिसीजन ऐसा हुआ है, हम लोग व्यापार कर रहे हैं. लेकिन भारत बंद के लिए हमारा साथ तो सपोर्ट नहीं है, किसान लोगों को सपोर्ट हमारा है.
Well, coming to you, you're a trader. Can you tell us that on any other usual day, the number of supplies that you receive, has it been affected today?
No, not that much. Compared to yesterday, we have just received around 10,000 bags less, which I would call it average. I mean, I wouldn't call it shortage.
Okay, let's move right on and let's talk about some trends witnessed in the credit card space. We witnessed outages at two top lenders, following which RBI instructed HDFC Bank to hold its digital launches and strengthen the online platform. Amid this, on the Money Show, we caught up with Anshuman Mishra of Loan Adda on how one should go about picking the right bank for digital transactions. What are the parameters to judge the system of the bank? Here's what he said.
Today, as the RBI has pointed out that you need to be clear as to what your digitalization is. So when I see the largest 5.6 crore customers and 85% of its bank is digitalized, I see that when you are having your credit card from somewhere who's the largest issuer, if you keep there your current account or your savings account there, that obviously makes a lot of sense, because as I said, go to Pepsi Cola and Coca-Cola in the largest queue rather than a smaller line. So if you go to a college fete, you go to where the maximum queue is, or that's a normal tendency. And these people are by far the largest issuers. So I think what younger customers can see is that one of the places where you can open an account digitally, which are very strong, is like an IDFC First Bank, because they give a very high rate on the savings. So suppose now our youngsters were using credit cards who are the first time new to banking. So they can go to a place like IDFC First or or an HDFC, which are very strong in their digital application. And you must differentiate that. Okay, if you want a credit card,
Then credit card you take who's the largest issuer, which is like an HDFC, or number 2 is an SBI. Whereas if you want to open, so you can actually differentiate. You should not keep all your eggs in one basket. So your debit card should be different and your credit card should be different. So in your wallet, you should have more than one.
Okay, well, that was, of course, a very important update. But as we draw close to the end of the show, let's address the quiz question we have for you. Which IT heavyweight reported the highest ROE in FY20? That's return on equity. The options were TCS, Wipro, Tech Mahindra, and Infosys, and the correct answer is TCS, without a doubt. We have 3 guys who got it correct. We have Sandeep, Bomisetti, Damodar, and Umesh. Congratulations to you guys, a hearty one at that. Keep tweeting to us, and if you get it right, you'll be featured on our channel every day. But on that note, it's completely out of time here. Bye from Karunya and me. Stay tuned to ET Now.